What's up, everybody? Right before we get into the show here, just want to give a quick shout out for our next Blockworks conference coming up in just over a month. Permissionless 4 is happening June 24th to 26th, and it's a crypto conference all for the developers and builders in the space. We're going to be hosting it right in the heart of Brooklyn, New York, and it's going to be a ton of fun. There's going to be a lot of fantastic speakers, and the whole Forward Guidance crew is going to be there. Myself, Tyler, Quinn, we're going to be doing a live roundup. There's going to be some wicked community events. Come meet us, have a beer with us. Come see some of the awesome side events, some fantastic speakers. There's new ones being announced every single day. So go ahead and get your tickets. Use the code FG10 to get 10% off and don't miss out. This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. Visit blockdaemon.com to get started or book a call with their team today. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody, welcome back to another episode of Forward Guidance. And joining me today is repeat guest, David Cervantes, founder of Pinebrook Capital. David, always great to have you on the show. What's going on?
Hey, man, glad to be back. Thanks for having me.
Yeah, always a pleasure. I always love to have you on and just, deep dive into the granularity of all things growth, inflation, labor markets. You always have some fantastic forecasts, and those forecasts have kept you on the pretty right side of the trades this year, as I understand it. You've had a pretty good year so far.
Yeah, it didn't start off that way. I was pretty bulled up on growth towards the end of last year. It was just kind of the economy and everything was just firing all cylinders, and I was pretty ginned up on growth. And then again with some caveats of the ebbs and flows, and then once the new administration came into power, there's a lot of talk about cutting the deficit, rolling back government expenditures, and that started to kind of weigh on markets in terms of less fiscal impulse. I was anchored to the Trump 47 experience where it was kind of a lot of talk, a lot of whatever, and markets kind of did their thing from a policy standpoint. So I actually I was very slow to react. I'm not going to lie. I was caught a little flat-footed as the sell-off after I think the local high was, the all-time high was February 22nd, I believe. But anyway, give or take a few days, things started kind of selling off there. First, it was the budget stuff I mentioned, and then we started to get into this tariff thing. And again, I was anchored to the prior experience where I didn't really make much of it, and I'll admit I was a little slow to the trade to kind of manage risk. And then once we started having these mid to high single digit pullbacks, I said, wait a minute, this is I didn't pass a sniff test, and I even though I was a little late to pivot, I pivoted pretty aggressively and hedged all my U.S. risk. At the time, rest of the world stocks, mainly Europe, China, and even Japan, they were just on fire. And, in February, I did this study of, this is kind of an anomaly where, typically, after two standard deviations, the outperformance of the rest of the world relative to the U.S. kind of mean reverts to its historical trend. So, seeing that as an opportunity, I shorted the rest of the world stocks, and that actually really saved my year. That really, going into as the sell-off accelerated, going into late March and early April, and of course, Liberation Day, it was complete risk off, as you remember, and having all my U.S. exposure equally weighted short on the rest of the world side. Actually preserved my NAV. So my year-to-date pullback was limited to the mid-single digits. if I recall correctly. And then when the collapse came and Trump walked back the tariffs, I was able to repivot, reload, get super long, sell volatility, and I just stayed on the right side of the trade. So that's really, in a nutshell, I'm at just shy of 27% of this morning year to date, and around 37% since I started tracking my trades publicly or not publicly, but within my private feed on August 5th. So the performance has been solid. I'm pretty happy with it. But yeah, the rest, just going back to the thesis, the thought line there was, Europe was starting to outperform. A lot of talk about defense spending and kind of decoupling. And the big driver was European defense stocks and the German fiscal growth impulse. And I was just thinking at that point, this is just kind of stretch. So that was the thinking there. But that trade is still on, and we can go back to that later. But I just want to segue into kind of that's kind of been the year so far.
I feel like what you represent there is that 2025 has been the year that if you're macro trading, you got to be nimble and you got to rethink your priors pretty aggressively. And so I want to just take a step back and just look at the 30,000 foot view here of how are you thinking about the framework for basically the first few months of the Trump administration, where, to your point, it was these narratives, and we'll call them narratives because that's all they really have been so far, of austerity, Doge cutting, trying to get, the 333 thing, getting deficits down back to 3% from the 7% we've been at. And then I think it's really important to see that there's been this very substantial pivot over the last month as well, where we've seen tariffs come back. We've seen them start to change their narrative, less so about getting the 10-year down, more about trying to basically run the economy hot, have a huge fiscal deficit again. Looks like it's going to go from 7 to 8. So just walk me through. I think you call it like your big macro picture. And I just want to understand your big macro picture of how you're secularly thinking about the big themes right now. And especially looking at like that first phase of things where it was the complete 180 difference from where we're at in terms of where we're at today.
I call it, just colloquially, the BMP. The big macro picture for me is we are running these gigantic, enormous deficits. And, when Doge was a meme back in late February, early March, the numbers that they were talking and throwing around were just trivial. They were rounding errors to the budget. So I didn't take the budget reduction narrative very seriously. And the reality is a public sector deficit is a private sector surplus. So that is just a wall of money hitting the private economy. So it kind of, in a way, inoculates the economy from normal shocks that would, put it into a recession. So, as the sell-off in late March accelerated, look, you can have your priors, but you also have to keep an eye open to what's happening around you. So, I hedged my U.S. exposure, but I never bought into the, we're going to crash into a recession. If anything, I figured, we had about a 2 or 3 month window to walk back all this stuff, and that was kind of the window of weakness that I saw. If things, if we were still in this, tariff, war on steroids that we were what we were back in late March, early April, I was thinking, okay, if it's not fixed by late May, early June, then we're probably looking at a recession. But we had some time to walk it back just because of that wall of money hitting the economy. It's just kind of, excuse me, it kind of almost didn't matter. It's I call it the Teflon economy or the beach ball economy. You can throw as much as you want onto it. You can try to sink it underwater, but it'll bottom back up, and that's just because of these massive fiscal stimulus that's going on. It's just really hard when you have that much money going through the economy to put into a recession. That's because we live in a nominal world. So the real growth may slow down. Nominal growth will still power through. People will stay employed. People will spend money, and the economy will keep doing what it's doing. And that's kind of what's played out. I didn't run into the risk off trade I got neutral, I got hedged, but I didn't run into a risk off trade in late March, early April. I just didn't see it because of my view of how stimulative these deficits are. Not only that, once Trump started talking about his tax proposal, I said to myself, "This is game over. That's it. The economy's going to light up." I mean, we're talking, the salt tax. That's a big one. Raising the limit on salt. For those unfamiliar, it's state and local tax. So basically, property taxes and some state taxes are going to be written off against the federal tax liability again. So once that, I was like, "This is a game changer." And then extending the prior tax cuts, and there's some gimmicky stuff in there, which is kind of just for show. But this was by no stretch a reduction of the fiscal impulse. In fact, it was the fiscal impulse on speed. It was very stimulative. So I figured once the tariff noise kind of dies down, the economy, it's going to have to digest what happened, but it will be positioned to probably reaccelerate. And markets are pricing this in. They're we're not at all-time highs yet, but the market, a lot of the talk about revisiting the lows, we're nowhere near that. It's not even close.
If you're building anything in crypto or institutional finance, you need to know about Blockdaemon. They've been powering blockchain infrastructure since 2017 and are now securing over $100 billion in digital assets for more than 400 institutions. From institutional staking and node infrastructure to MPC wallets and APIs, Blockdaemon is the go-to partner for performance, scale, and security. Learn more at blockdaemon.com. This episode is sponsored by Arkham, a crypto exchange and analytics platform that lets traders and investors review on-chain data, then take action in the markets. With Arkham Intel, you can see what top traders are buying and selling, and then trade directly on that information through Arkham Exchange. Arkham was built to make blockchains human-readable, simplifying data into meaningful insights for the average crypto user. To start using on-chain data as your edge, go to arkham.com. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Today's episode is sponsored by Echo Protocol, the leading Bitcoin liquid restaking and yield layer on the Move VM. Echo is already the number 2 protocol on Aptos, securing nearly half the network's bridged assets with over $200 million in ABTC minted. They're unlocking new layers of utility for Bitcoin by allowing you to bridge your Bitcoin or BTC liquid staking assets and earn yield on Echo Land. You can also stake Aptos for liquid restaking rewards like EAPT. Backed by names like Spartan, Maelstrom, Selene, and Aptos Labs, Echo is where Bitcoin meets next-gen DeFi. Visit echoprotocol.xyz to explore staking, lending, and bridging. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Yeah, David, I'm curious if you've looked into and thought about the specific subcomponents of that high fiscal deficit, because my assumption is a lot of that has just been the huge increase in interest payments. And it creates this interesting paradox where you think, okay, the Fed is going to hike rates a bunch to try to slow down the economy and, get their landing, get their inflation rate back to 2%-ish. And, at the time when they started to jack up rates like that, they're saying, if a recession happens, so be it. But then we're looking at this dynamic where if the biggest driver of the increase to the 7% of GDP fiscal deficit has been interest payments, if that is correct, it's this interesting paradox where it feels like the poison that the economy is supposed to take, which is higher rates, is actually the thing that is keeping it from going into recession. Is that how you view that dynamic? And if so, it feels like a recession is almost impossible at this juncture. Is that how you think about it?
I wouldn't be so extreme and say impossible, but it raises the bar. And I think, without going full MMT, which I don't subscribe to that worldview, there is an element of, look, the government is basically recycling all these interest payments back to the private economy, right? Bondholders get paid their coupon. So, that money, these interest payments that the government's paying out, those payments are making their way back into the private economy, and they are providing a further stimulative effect. So yeah, it does raise the bar or make it harder to send the economy into a recession, for sure, no doubt about that. I mean, I wouldn't say impossible because, again, that's just when you anchor to extremes. You kind of it's I've been in this business long enough where you can get rug pulled pretty easily by anchoring to this never happens, never will happen. But I think the probability of getting into a recession certainly collapses.
Yeah, I think that's the fair assumption, especially the idea of getting too anchored from one extreme to the other. Because yeah, it felt like 4 months ago everybody was all in on this idea of we're going to get to the point of balancing the budget, and now it feels like the whole narrative is entirely flipped to the other side of things, which is huge deficits. Nothing stops the stream. We're going to run the economy hot. S&P is going to go to 6,000 again pretty quickly. How do you navigate not getting too anchored to both of those sides? Like, how do you discount the fact that, okay, yes, it's been empirically proven that when we're running such high deficits, the economy is unlikely to slow down meaningfully, and also nominal asset prices, i.e., equities and not bonds, are probably going to do pretty well. So, how do you take hold of that framework without getting too carried away by it?
Yeah, I think what's important to introduce here is this concept of the lags that are associated with different sectors of the economy. Specifically, with these tariffs, you're going to have these bullwhip effects where the data that we see is really kind of an echo of past activity. So I think recognizing that, for example, we have this negative GDP print in Q1, it's kind of like a false positive, a false negative in a way, right? And then right now, I think GDP, according to the Atlanta Fed, which kind of, I don't think it's the best model, but everyone uses it. So, it's like in low two handle, 2.2, I think it is. Doesn't matter. So is the economy really, did it really stop in Q1 and then suddenly reignite? Not really. I think
it was a false negative because it was mostly driven by net exports, like imports just blowing out. Right?
Correct. But so just navigating allows you to kind of see through this kind of, separate the signal from the noise and understand what's really happening behind the scenes and what's most likely to manifest itself in corporate earnings so we can make money. But it's really understanding, having a sense of these lags, having a sense of these echoes, and not getting too carried away by this or that headline of, oh my God, whatever. It's just, tune out the noise, focus on what's really happening, which is consumer spending is strong, employment is strong. The part of the labor market that does concern me, though, is not so much layoffs. I think there's a false comfort in the weekly claims numbers. They haven't rolled over yet. And look, without a doubt, the labor market is pretty solid. I think that the concern for me is that you can have a recessionary labor market without mass layoffs. You can have that via hiring just slowing down, and that's kind of what happened after the dot-com bubble. After the dot-com bubble, or during the dot-com, you didn't get this wave of this employment extinction event. What you got was just less hiring, and that caused nominal spending to slow, and eventually there was also capex issues post dot-com, but there was no real traditional labor market rollover, and then that led to the phenomena of the jobless recovery. Since there was a mass firings when the cycle eventually turned, there was no labor hole to fill with aggressive hiring, so they called it the jobless recovery. And I think I'm seeing parallels with that. In other words, weekly claims are solid, continuing claims continue to go up, and the weakness in the labor market is coming from a lack of hiring or less hiring. So we're kind of in a no fire, excuse me, no hire, no fire type of labor market. But if that goes on long enough, that could introduce recessionary pressures into the labor market.
David, on that point of the labor market, I'm curious. I want to bring into the fold this dynamic of immigration on the labor supply and the labor market, because I'm curious if there's any other historical comparisons where we've gone from the largest amount of immigration to the point where it's like literally bringing the unemployment rate higher. And you flagged that very well last fall, where the SOM rule was getting triggered just because of this huge labor supply growth, and you said to fade it, which was correct. And now we're in the complete opposite direction, where we have
Right.
almost like no immigration. So how do you bring into the fold that dynamic into your labor market outlook?
Just to recap, last year the labor market was slowing pretty quickly. U3 was starting to rise. We had a couple of months in summer where I think we had like a these 20 basis point jumps in the U3 rate, which kind of freaked everybody out. And my view then was it was kind of a false signal, because the labor market had just grown so much that the NFP numbers weren't, just arithmetically, the NFP numbers weren't strong enough to keep U3 at the current level, at the then current levels. So U3 started rising, but the causality was really just immigration, not a fundamental slowing of the economy. And we are seeing that that whole thing completely inverted, where because of immigration, the labor market is actually shrinking. And what's going to happen is, even if the economy slows and we put up soft NFP prints, say, sub 100. So just to take a step back, to keep the break-even rate roughly right now is roughly, I don't know, it's a kind of voodoo, but it's roughly 135, 140,000 NFP prints to keep U3 consistent over time. And of course, you have some soft months here and there, but a kind of a moving average. If NFP starts to dip below 130-ish, certainly below 100,000 a month, you're going to see U3 rise. But because of the shrinkage of the labor pool, now you don't need NFP to be as strong to maintain a baseline U3 rate. So we could see soft labor market prints, NFP prints sub 100, and U3 either stay flat or not move up very meaningfully in a way that would put us in danger of tripping the SOM roll. So I'm going to start fading soft NFP prints. I think there's going to be a lot of noise there. I think there'll be a rush to, you'll get some instances where weak NFP, oh my God, it's the economy slowing, and I'm going to fade that for that reason.
I'm interested too in the other side of that equation, where you might see, we can start to talk about the Fed and how they start to think about this now, which is, okay, if they look at the U3 and it's flat and they're saying, okay, well, it's not right. And obviously they're smarter than both of us. They'll know that a lot of it is like immigration driven, but regardless, if they're too anchored to the fact that U3 is not rising, and so then they sit on their hands for longer than they should, do you start to see the recipe for a policy mistake? And maybe we can bring it to the fold, the inflation side of the mandate, because you forecast that and look at that very closely too. And obviously those two are in close tension, but obviously that's above target. And then if you have the U3 that is staying flat because of this immigration dynamic, does that create the recipe for a potential mistake here, or are you pretty comfortable with that dynamic?
Let's take a step back to what's the outcome the Fed wants, right? They've signaled that, in this whole cycle, they've signaled they're willing to pinch their nose and look the other way of inflation to protect the labor market. That's kind of been, and we can get political and call it dovish or whatever, but the bottom line is that's what they've done. Inflation, they've gone after it, but they've prioritized, for the most part, the labor market. And this is why we got the soft landing. This is why they didn't throw the, they also got lucky. Let's just be clear. They got very lucky by a confluence of events with, again, the deficit spending and a bunch of other stuff. But, they've prioritized the labor market. So I think they're going to take their cues from the labor market to do what they need to do to both support it and meet the dual mandate. So what does that mean? Inflation is currently running, I think, I'm looking at roughly 0.12 core PC month over month for April. I think that'll put us, off the top of my head, around 2.56 core year over year. certainly a little cooler than it was earlier. Q1 has seasonally been the hottest quarter of the year. In each year in this post 22 post 20 cycle, post whatever, it's been Q1's been historically the hottest. So I think what's going to happen is as we get these base effects, we'll see some and then you put in the whole, the bullwhips from the front running the tariffs and taking a pause on orders. We'll probably get a softish inflationary window as we head into summer, and that will give the Fed the green light to maybe cut once. I'm still calling for a June cut. That's the window. Why? Because by late summer, the economy should start to pick up again. We will see some inflation coming pass through from the tariffs. They'll look the other way and say it's a one-off. It's a level reset, not a rate of change issue. But the economy will probably reaccelerate going into year end, and they cannot be. And if we see some inflationary impulse, it'll be optically and politically hard to do any further cuts. So I'm actually calling for a one and done in June. If they're going to do it, it's going to be one time. It'll be in June, and that will allow them to again support the labor market while preserving some optics of going after inflation. And if you get an inflationary impulse in late summer, they'll just say, "Hey, this is a one-off. It's tariffs. It will revert back to trend."
Sequentially, that makes sense to me, and it feels like that is the one window that they could have. But I just looked at the Fed futures forward curve, and the market does not think that a June cut is coming. So I'm curious, what do you think would be the catalyst? Is it just everybody is too afraid of a hot CPI print based on tariff impact, and you think it'll come the other way? What's the catalyst for that? And what do you think is the market missing in terms of the potential for that June cut? Because right now it's at like 97% odds of a pause. So what are you thinking there?
Yeah, so I think the idea is, this Fed has shown not only just a preference, a revealed preference to the labor market, but they've shown a desire to kind of front run weakness. I call it the Roman playbook, where they're willing to say it doesn't matter if inflation is not where we want it to be. We're to look forward and actually make a projection. In other words, the prior Fed regime was one of a reaction function. We look backwards, we see what the data is telling us, and we'll act appropriately. And this is why you always have this cycle of policy mistakes, right? They raise too late, they raise too late, and they cut too soon, or some combination of a mismatch between what the economy needs and what they're really doing. And this new playbook of actually, generating a forecast and front running these kinds of the economic developments has allowed them to, do the soft landing, land it. And now that we're slowing down, to use this, I think it's gone overplayed, but to use the soft landing analogy, we've soft landed, we've been taxiing on the runway, slowing down, and we will probably come close to hitting stall speed or stopping on the runway before heading back to the gate, refueling, and heading off again. That's kind of, it sounds hokey, but that is kind of the way I'm seeing it, where that's how the Fed is thinking about the economy. It's slowing down. We're gonna front run that weakness with some stimulus, so that we don't actually stop, and we keep nominal spending, we keep employment, we keep all these things moving forward. So it's kind of a front run mindset, if you will, on behalf of the Fed.
It sounds like, regardless, like let's square this all together with your high level growth outlook, which it seems like even if we don't get that June cut, the economic fundamentals, especially from this upcoming fiscal impulse side of things, which is just a guns blazing tax cuts, front loading the stimulus, then the savings I think come at a later date, if at all. But overall, like how does that square up with your growth outlook? It sounds like it's obviously pretty constructive.
Going into late last year, I think my price target on S&P 500 was 72 something. Obviously that's we're highly unlikely to hit that, but I think there's a solid chance that we do end up above the consensus. I think the consensus is back down to somewhere 63, 6,400 on SPX. I think there's a very good probability that we'll end up above that because, the market is just going to say, look, earnings aren't falling apart. Even if there's we have to, kind of, we've had this kind of kick the can on earnings since 2022 where, you know, um, prospects get talked up, then they get talked down, and it's like, well, we'll push out the growth prospect till the following quarter, the following 2 quarters, or the following 3 quarters. We'll just kind of give this quarter a pass, and as long as the cycle uh, stays uh, uh, positive, as long as we don't go into recession, then the market's fine with that. The market will say, okay, fine, we'll keep looking forward now. Now we're looking at 2026 earnings. 2025 is done. We're done with 25. Now the market's already looking at Q1 and Q2 26. So that's the way the market is factoring this stuff in. And by then, if we dodge a recession, and now it's looking like the soft spot of the year will be Q3. The market's already looking at Q2 of next year. So who cares? So maybe at that point, then if you think about it that way, then 6,300, 6,400 is too low. Now we're looking at future growth, which should be a little higher by then. So that's the way I'm thinking about it. The market front runs all of this.
This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. They're the #1 institutional staking provider by volume, managing over 250,000 nodes globally with over 70 points of presence. Their ISO 27001 certification and slashing risk protection means your assets and operations are backed by audited security standards and 24/7 monitoring. Whether you need secure notes, MPC wallets, or staking at scale, Blockdaemon delivers enterprise-grade reliability and peace of mind. Visit blockdaemon.com to get started or book a call with their team today. Meet Arkham, the world's first crypto exchange powered by crypto intelligence. Arkham allows you to review on-chain data, see what the top traders are doing, and then act on that information with Arkham Exchange. They've made blockchain data human readable with features like profilers, visualizers, and custom dashboards, making it useful and actionable for everyday crypto users. Arkham believes that transaction analysis, the study of wallet activity and fund flows, will match or even eclipse traditional technical and fundamental analysis. And in a cycle full of hacks, rugs, and scam bundled launches, the best protection is knowing who's moving funds and where they're going. That's crypto intelligence, and that's what powers Arkham. Head to Arkham.com to start tracking wallets, following flows, and trading with an edge. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Let's take a moment to talk about Echo Protocol, one of the fastest growing DeFi platforms on Aptos. Echo is pioneering Bitcoin, liquid staking, and restaking in the Move ecosystem with over $260 million in TVL and deep traction across DeFi protocols. Here's how it works. Bridge your Bitcoin or Bitcoin liquid staking tokens into the Echo ecosystem, mint a BTC, Echo's yield-generating BTC primitive, use a BTC in EchoLend to maximize returns, or stake Aptos to mint EAPT, giving you exposure to liquid restaking opportunities across the Move VM. With a mission to unlock the full potential of Bitcoin, Echo is quickly becoming a cornerstone of the Move-based DeFi world. Check out echoprotocol.xyz and start earning with your Bitcoin today. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Yeah, I'm curious how you square into both positioning in terms of, especially like hedge funds and that. It just, looks like a lot like for the most part, it feels like retail's the one that caught the bottom, and hedge funds are still somewhat sidelined. I'm curious about how do you think about that, and then also the soft data compared to the hard data, where the soft data has severely dislocated lower, while the hard data remained okay. And now we're starting to see the soft data start to tick back up again. We had the consumer sentiment come out today, and it just blew consensus off the doors. It came at like 98, and consensus was 87. Previous spin was 85. So you have positioning where it's at. You have the soft data that was just in the dumps, and now it's starting to rebound higher. So does that just add fuel to the fire of this uptick when everybody's offside?
Yeah, I mean, I think there was I saw a post on Twitter by his name is Ben Carlson. I think he works with Ritholtz Wealth Management, but there's a chart going the rounds of the amount of cash in money market funds, and I think it's like 7 trillion. So there is kind of a structural retail bid, and I think retail, right? We can argue with it's rightly or wrongly, but I think retail has been conditioned to buy the dip. I think dips are bought, and that's become somewhat institutionalized in a social mindset, as well as from just as long as the cycle keeps going. And I think people learned, there were a lot of people that sold in 2009, they never got back in. There are a lot of people that sold in 2018, they never got back in. A lot of people that sold in COVID didn't get back in, and the market is not kind to those people. But life moves on and the economy continues. And I think people have been conditioned to say, okay, fine, I gotta, kind of squeeze my cheeks a little bit, but it's worth it because I don't want to miss it. I don't want 5 years to go by and this thing's 100% higher again, because it's kind of you almost have like a Pavlovian reaction now to sell-offs. It's just like, okay, buy the dip, So there, if you look at fund flows, getting back to positioning, there are a lot of fixed income negative fund flows in April. Where do they go? They went into equities. So yeah, there is this structural bid and position. All this interest income that's piling up in people's checking accounts, money market accounts. When there's a sell-off, the dip is bought, and it's very hard from a flows and from a mindset perspective to kind of bet against that. It's just really hard. You need the meteor to hit almost. It's crazy.
Yeah. Yeah.
It is wild. And once you kind of understand that, then maybe if you want to be an active investor, then you become a dip buyer. The only question is not so much if, it's a question of when and where. How much of a discount do you want to pick up?
Well, and to that point, my next question is what do you pick up? So the big narrative, it feels like the last couple of months is sell America. We've seen these days where U.S. equities down, bond yields up, so bond prices down, U.S. dollar down, and this narrative of big money needs to get out of the U.S. and go back home, go back to Europe, go back to Japan, et cetera, et cetera. So yeah, let's talk a bit about how to decide which side do you weigh. Do you fade that noise? Do you fade the U.S. dollar reserve currency is falling apart? No, it's still there. Or do you go on the other side of the equation and you go start to buy rest of world equity? How do you think about that dynamic?
So I think the narrative of the U.S. dollar, reserve currency going away, or the U.S. dollar going away as a reserve currency, I think it's just, it's sensationalist noise.
You can swear on here, Dave.
yeah, it's bullshit. I mean, and there's one reason, and we can talk about all these other crazy things, but the reality is the U.S. is the only market large enough to absorb all of these flows. There's just no other market. These are Europe collectively had, I believe, roughly the same GDP as the U.S. did coming out of the global financial crisis. Now it's a fraction of that. The U.S. economy is orders of magnitude larger than Europe. We have the strongest consumer base on the planet. There's one thing this country can do is spend. So we are the consumer of last resort. We will pull in capital. We have the markets, the market depth, and forget the the rule of law arguments. We just have the size to accommodate these flows. So I think the U.S. And this thing took decades to build, And even if nationalist policies chip away at that, I think it would take, I think to really in our lifetime to get the U.S. to not be the reserve currency, we would basically have to lose Connecticut to China. There's just no other way. It would take a, 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 a severe body blow to the U.S. from China, where they basically win, they rewrite the rules of the global order, and we take a backseat. But other than that, there might be some degradation, there might be some whatever. But this is a not in my lifetime problem, so I'm not going to worry about it. In terms of what's the trade, so interesting. I was pretty going into the sell off. I was like, my thesis was a couple of things. The outperformance that we saw from rest of the world stocks at the end of the beginning of 25, a lot of that was just making up for the prior 6 months. Europe was actually, or the rest of the world was actually down roughly. So I have to go back to my spreadsheets and my graphs, but roughly September or spring through the fall, the rest of the world was down. So part of the initial ramp we saw in January and February was kind of catch up. So I kind of saw it as, this is anomalous, and that's what gave me confidence. But the short on now, obviously, I'm starting to re-question that right now. The anomaly of the U.S. underperforming has gone on for longer than it typically does. So I use a 100-day rolling look back window over the past decade, and typically the U.S. outperforms the rest of the world by anywhere from high 2% to high 3% on a rolling 100-day basis. That means every 100 days that goes by, the U.S. typically done 3% better than the rest of the world. Right now, that is completely upside down. Right now, the U.S. is lagging. But what's crazy is that it's not just lagging, and that's going to happen, right? I mean, there'll be periods of under or outperformance. The thing is, the U.S. is lagging Europe by 3 standard deviations. I mean, that is just, it's not just 3 standard deviations as a one-off. It's persisted. You've had some pockets, but it's persisted, and that's making me wonder, do we have a regime change? Do we have, is this kind of just, cyclical flows, or do we have fundamental realignment of the economics between, the two countries? And a lot of that's going to go back to the tariffs. How durable are these tariffs? So much of this is just, Trump being Trump and talking, and people, positioning that and arguing that, or how much of this is going to be durable and etched into stone that really realigns this global flows around that. So right now, I think the jury is still out on that. I've given up my short rest of the world long USA trade, has given up about half of its gains. So I'm holding on for now, but always, the way I approach it is, strong opinions weakly held. I mean, that's you got to pivot, you got to face reality. So the trade is still profitable, but yeah, about half my gains are gone roughly. And I need to revisit that thesis.
Yeah, I'm curious. Yeah, just within that, I mean, it felt like, so the way I thought about it was, back in February, you had, okay, the narrative was the deficit in the U.S. was going to go from 7 to try to get to 4, 3-ish or whatever. And on the other side of the trade was, Germany taking off their debt brakes and starting to go big on fiscal. So if you have the opposite dynamic where countries like that are, I don't know what Europe is at specifically, but let's call it 3%, and they're trying to go to 5% deficit. So to me, that made sense at that time to be long rest of the world, short US. But now you're in this regime where, okay, well, US fiscal deficits are going from 7 to 8. And then the rest of the world, it seems like, regardless of what happens to tariffs, the fiscal shackles are coming off anyway. At least that's something you have to discount and assume, but it feels that way right now. So if you have those from going from 2 to 5, it feels like the trade is long everything, short bonds.
Yeah. I would think that's right. I mean, but I think you also need to get down to sectors, right? I mean, the European defense stocks, I forget the name of the ETF, EU something, EU AB, that thing's up 66% this year, right? Now with this kind of, where if the U.S. is pulling back on its security guarantees to Europe, and Germany's looking at rearming. Poland's obviously going to be frontline there. Finland as well. On the defense side, you got to look at these sectors. They're going to be in a secular bull market. It's not just I don't know if this is how sustainable it is on the consumer side, or tech. Forget about it. I mean, Europe can't compete on the tech side with the U.S. Not yet, at least. But I think you have to be sector specific. I think the easy rest of the world trade, the easy money's been kind of done on that one. I think now you have to go into sectors.
So what do you think about fixed income at this juncture? It feels like every country's long bond yields are just surging right now based on this fiscal unshackling and maybe some other dynamics as well. But yeah, I mean, if you're correct on this idea of economic acceleration of sorts, and you look at positioning, et cetera, like a lot of people are positioned in long bonds ready for a recession. So yeah, what's your read on fixed income here?
So I think we're range bound. I mean, if you take the idea that, okay, we're not going to go into a recession, then you got your floor on yields. You're probably looking at 420, 425. And
For the 10-year?
And on the 10-year, yeah, that's kind of the one I focus on. So if you're not going to go into recession, that's kind of your floor. And depending on where where the deficits end up, and then also the terming out of the debt, where do they do the Yellen thing and go lean heavier on the short end, issue more bills. So depending on issuance and how they manipulate the curve that way, and let's be clear, it's manipulation. That's fine. It's okay as long as we recognize it and make money off of it. It's what matters. Depending on how they manipulate the curve, I think 480 is kind of our top, and that's just kind of based off back in 23. I think in October 23, we were at, I think 5.05 was kind of where we peaked out, and the economy is slower. We were coming out of 22 and a really strong acceleration in 23. So, and we got these tariffs to deal with. So, we could reaccelerate. I don't think GDP is going to be, hitting 4% handles. So, nominal spending will stay supported. So I think, 480 is kind of, we'll be in a range. It's, and it'll go with the different flows of the cycle. But, roughly 420, 480 is kind of your trading range on bonds. Yeah, I think they're, for the most part, shitty investments for now. I think they're trades. They are tactical, and you got to be nimble. But I think as an asset class, I think it's a pretty shitty asset class right now. That's the answer.
Yeah, I mean, shitty for investment, but it feels like a 60 basis point range. That's not even that great for trading either. It just feels like there's better opportunities elsewhere. Are you putting anything on, or are you focused just on other asset classes?
So I've been looking at gold mainly as I shorted gold a few times and pretty much broke even. But I think gold, because of there's very aggressive central bank buying, particularly China, I believe. Gold is a secular bull market. I think gold can I think 3,800, 4,000 is kind of what we're looking at for the year end. I mean, there's a lot of juice there. I was, when I was shorting it, it was kind of more of a tactical US dollar bounce. But I think gold is kind of, for now, your risk off, non-correlated, portfolio stabilizer that fixed income used to serve. Right now, because of the stock bond correlation, fixed income isn't much of a diversifier. I think gold is starting to fill that role of a portfolio diversifier. So that's an area of interest to me.
Yeah, and then also you wrote a piece on your Substack, which we'll link in the show notes on all that. Pinebrook, really great stuff. But you wrote a piece about us looking at small caps versus large caps. And I'm curious how you're thinking about that, because the way I think about it is, it feels like trying to take an outlook on basically floating rate debt versus fixed rate debt. If you go large cap, you go Apple, whatever, they can issue huge amounts of fixed rate debt at pretty low yields, versus these small caps where they're a lot more sensitive to Fed funds rates because so much of their debt is floating rates. So that's what I view. But I'm curious about how you're thinking about those the small caps versus the mega cap tech stocks there.
Well, let's go back to earnings. And I think something like 42% of small caps, for me, the universe of small caps is is RGK, Russell 2000. So, some people look at S&P 600, S&P 400, but I'm looking at the broader universe of RGK. So roughly 42% of these companies are unprofitable. I mean, they're just not a great collection of companies. And I think there's some structural reasons for that. I think, a lot of the regulatory environment, both after .com as well as after the global financial crisis, raised the cost of equity, of public equity capital. I think for higher quality names, it's cheaper from a funding standpoint to stay private. So there's been kind of some selection bias there where the better companies have migrated out of the public indices, and the indices has become more of a concentrated pool of shitty companies. So starting with that as kind of context, then you're left with, all right, well, what's going to move the dial on these things? What's the big, to your point earlier about debt? What's the biggest thing that small caps are facing? It's their cost of funding on the debt side. Since they're not very profitable, it's hard to sell equity, so they rely on debt funding. So I view small caps as basically a high yield trade and drag for normies, so to speak. In other words, your average person can't really trade high yield credit indices or whatever. That's fine. There's different ways to replicate that, and one of them is small caps. So you will get some small cap appreciation when credit spreads are blown out. Like, let's say, for example, in April of this year, Liberation Day, the time to buy small caps is really kind of a recovery trade. It's really when spreads are blown out and then they start to normalize pretty quickly, that you get that convexity that positive convexity from the funding structure, and that allows for some small cap outperformance. But other than that, we've kind of just structurally, gone away from the French Fama factor school of thought of the small cap illiquidity premium, value. That whole paradigm has kind of been turned on its head. That doesn't work
anymore. Feels like it flows over factors.
I mean, it's just I don't know if they still teach that in business school. I think you did the CFA recently. Do they still teach that CFA? Is that part of the curriculum? Yeah. So it's just like, it's kind of a toy model that no longer resembles the real world. It's great on paper, but if you're a small cap value investor, I mean, my God, I mean, it's been a journey. It's been a painful one. So yeah, I think there's a kind of structurally a shitty collection of companies, and yeah, it's really a recovery trade. Whenever there's been outperformance, it's really been coming out of some kind of shock. I think in the past decade we had 3 years. I think we had 3 years. In the past 15 years, we had 5 years of small cap outperformance, and 3 of those were from kind of a post-recession, post-recovery kind of shock trade. The other 2 was kind of really, I don't even call it random. When you got 2 out of 15, I would just call that random, shit on the wall noise. You can't build a portfolio out of that. It's a trade. That's all it is. So stay away from them.
I'll throw you the other side of that trade just to get your thoughts on it. But if we're going into reacceleration, and that means less cuts, that would mean, and at the same vein, you have whatever you want to call it, but some sort of treasury bond yield management of the long end that keeps it artificially weak versus what it should be. It feels to me that sets up a better trade for those big companies that can issue debt on that long end of the curve versus these small caps that are just at the whim of the Fed funds rate, basically, which prices off SOFR. It feels like if that is the case, I mean, this is what we saw in 2022, right? Where tech stocks just did way better than small caps, even though we're in this high rate regime.
There is one pocket of small caps that can be okay with what's coming up. And what's coming up, there's a lot of talk about bank deregulation, where a lot of these post GFC regulations are going to get rolled back. So what does that mean? These cap SLR ratios, what constitutes a SIFI, is a systemically important financial institution. I think they're going to raise a threshold on that. So if you're a mid-size bank, you no longer have the same regulatory burden that a JP Morgan has. So I think, if there is one area of potential strength in the small cap universe, it will likely be in small cap banks. The other one will be obviously in defense contractors, but that's a very narrow field. A lot of the defense contractors are at that level aren't really public companies, or really privately held. But I would say that's if you really have a real a real fetish for both small caps and some abuse, then I think your calling is probably in mid-size small cap banks.
All right, David. Well, yeah, we covered some good ground there. Always great to get you on the show. Where can folks go if they want to see more of your work?
Thanks. Definitely happy to be here. Pinebrookcap.com. So that's all my stuff's there. I opened up the paywall on my small cap articles, so that's you can go there and read that for free. There's some other free content. I should probably highlight that, but pinebrookcap.com. That's the answer. Also on Twitter at econstrat pb is my public Twitter handle.
Right on. Well, yeah, always good to get you on the show, and nice work on some outperformances here against your benchmark. So props to that as well.
All right. Thanks, man.